Hello listeners and welcome to the Montel Weekly Podcast, bringing you the most topical energy matters in an informal setting. My name is Richard Sverrisson. Today, in a carbon market special, I'm joined by Tom Lord of Redshaw Advisors and my old pal, Alessandro Vitelli. Alessandro has been covering this market since about 1890. A warm welcome to you both anyway. I think we should start by discussing current market dynamics. We've seen prices come down after a volatile period after summer. What are the main drivers here, Tom?
It's a mixed bag at the moment. We have a few bullish influences and a lot of bearish influences as well at the same time. So we've seen prices stuck in a fairly tight range.
Could you isolate the sort of both the bearish and the bullish factors?
Sure. I think on the bullish side, we have the MSR, which has been going all year. Lack of UK auctions, so the Brexit uncertainty is ensuring there's no auction on a Wednesday every fortnight. We have the December auction shutdown on the horizon now. So midway through December, the auctions will cease until the new year, and obviously we're coming into winter. So winter is generally supportive. Obviously higher heating demand from across Europe. In terms of the bearish influences, we have European gas prices. So I think that's probably the main bearish driver at the moment. We also have the Brexit uncertainty isn't helping. And coupled with that, you have the potential return of UK auctions. So depending on the outcome of the Brexit saga, you potentially have those UK auction volumes returning to the market in 2020. So UK auctions adding to that supply in 2020, perhaps in a short space of time, makes Q1 look particularly vulnerable to lower prices, perhaps.
Alessandro, do you agree with these factors? Is there anything you'd like to add to that?
I agree with them all. I think they're all relevant factors in how the market is playing out at the moment. It's trapped in a fairly relatively narrow technical band. There's no great dynamic that's pushing it one way or the other. And as we near the expiry of the 2019 contract in December, there's going to be less desire to move it away from where it is now simply because of the option open interest that is congregating around about the current strike price. So as the further we go, I think the less possibility of a breakout comes. After expiry, there may be a change as people start to look into 2020 and start seeing maybe a more bearish outlook, as Tom indicated, for Q1.
But so this narrow range is what, between 24 and 26?
24, 26. I mean, we're currently hovering, I think it was just above 25 lately. The point there being that people see no reason to move it. The lack of any speculative interest in the market to see it go higher, to see it go lower, suggests that hands are off. And we get towards the end of the year, traders start slowing down their activity. They're closing their books. They don't want to put their current bonuses at risk. So you've got this sort of hands-off sentiment now. People sort of go quiet.
Would you agree with that, Tom? Do you think sort of speculators are taking a bit of a break? Or?
Yeah, I think so. We have seen prices obviously stuck in this range and very closely correlated with the wider energy complex, which usually suggests that there's nothing in particular driving carbon alone. It's seeking direction from elsewhere, and there's bearish outlook on the UK gas prices, and European gas prices have largely driven the kind of downside that we've seen over the past few months, I would say. But we've seen prices come away from the summer highs and then kind of find this range that it seems happy in. It seems comfortable reverting towards 25 at the moment. The year-to-date average is 24.91, I think it is. So it's reverting to that.
I mean, how do you see the market developing for the rest of the year? I mean, would you concur with Alessandro that, after December we could see a different dynamic? I mean, after the expiry date of the December contract?
Yeah, quite possibly. And the expiry date also coincides with the auction shutdown. So what we typically see in an auction shutdown is higher prices, just because there's no supply coming into the market and there is still hedging demand. But this August certainly went against the grain on that one, and a lot will depend on the UK election, and therefore the influence that we see with the Brexit agreement and the return of UK auctions in 2020. So if the UK auctions start again in early 2020, there's certainly the chance that any gains in late December because of the auction shutdown are countered by happy sellers.
We've had someone on this pod arguing that carbon prices could reach 45 by the end of the year. From what you're saying, Tom, and Alessandro, I think you have quite a different opinion.
Yeah, it seems very unlikely, I would say. You can't rule it out in carbon. It's a very volatile market. But gas prices look like they'll keep a lid on the carbon price for the foreseeable future, I would say.
There's also some supply and demand dynamics that are going to come into play. I mean, let's focus firstly on Brexit. The deadline for an agreement is the 31st of January. And history teaches us that we always use that up before we get to an extension or whatever. So we get to the end of January, let's say there's a deal. The 2019 UK allocation and auction have to come to market. Now, are they going to come to market in a compressed period of time, that is until the compliance deadline at the end of April, or are they going to be spread out over the whole year? What is the logistics of 2019 compliance if we have a deal? Secondly, UK utilities.
So that would mean a flood of these allowances on the market in a very short space of time, which, as Tom hinted earlier, that could drive prices very much downward.
And if we do only get this deal at the end of January, you then have February, March, and April in which to sell, I guess, between 60 and 70 million EUAs perhaps into the auction market and issue all the free allocation to industry. They then have to quickly balance their books and give it back to the EU at the end of April and give those EUAs back to the EU. That kind of volume coming into the market in that period of time can only be bearish. Now, you then have, assuming we have this deal, you then have the UK continuing to comply until the end of 2020. So while the 2019 EUAs are coming in, the UK is also starting to sell and issue the 2020 EUAs. So you've got 2 years of UK supply coming to the market at the same time. That's got to be bearish. Now, go even further than that and look abroad, look across the channel, look at what the last week's decisions from Germany. 2020, they're going to start tendering for the first coal plant closures, middle of the year. The plant has to close 7 months after it's been awarded the tender, I believe that's
right,
the case.
Yeah. From the details we saw, but it's still only a draft program.
Still only a draft program. And then they've also delayed a decision on cancellation of EUAs until 2022. So you then have this lack of demand coming along the way, sometime at the end of 2020 probably, from German coal plants that have shut, plus the German government continuing to offer those EUAs at auction anyway. So we're building up more oversupply on top of reduced demand from the power sector due to decarbonization and renewable energy, due to the downturn in economic output, which is causing industrial emissions to drop.
So it's quite bearish outlook.
For me,
there.
2020
is
nothing but bear.
Looks like red arrows.
It does.
You, Tom, I mean, would you share this view of Brexit? I know that amongst all the uncertainty sort of this year and certainly after the summer, when it looked like there was a deal coming or when the certain acts were passed in Parliament, prices went up. But actually, the impact of Brexit or a deal is fairly bearish, as Alessandro has just said.
Yeah, I think a lot depends on the timing of the UK auctions. We would expect those allowances to come to market in a fairly short space of time, but the UK government will also be conscious of the impact of those auctions on the market, and they'll also be conscious of the auction clearing price. Their auction revenue is directly correlated to that auction clearing price. So there's no clear picture yet of how quickly those auction volumes will come to market. And I think the key with the auction volumes is who buys them. The largest buyers of allowances are the utilities. And it's our understanding that UK utilities have carried on hedging regardless of this Brexit uncertainty. So if they've already bought, who then buys the allowances that are coming to auction? And that's a big question mark, I think. There will be some compliance demand, and UK industrials in general, and I'm splitting the industrials from the utilities, UK industrials in general have taken a step back from hedging. Obviously, I can't speak for every single one of them, but a lot of them have not carried on hedging their 2019 exposure. So they will have catch-up, but it probably won't be of the size of the UK auctions. In fact, I'm certain it won't be. They could well be joined by speculative or long-term investors who are happy to come back into the carbon market based on the fact that they now have that all this Brexit downside risk has gone away. But there's certainly a lot of question marks around 2020's price development, especially in the first quarter, maybe first half of the year, I would say.
Sure. I mean, a lot of the UK utilities are also foreign-owned, as it were, or not. The headquarters are the companies based outside of the UK. So obviously they have a big trading and hedging strategy, which is either in Dusseldorf or Paris or Brussels, wherever that may be. And one of the UK industrials, that was the famous example, Tata, which was then obviously it wasn't so hedged. That's quite a key example. Alessandro, do you share this view that the UK utilities? You were sounding an imaginary bell there.
Because I think that's the key point, is that UK utilities, responsible, publicly quoted companies, will not leave themselves open to that kind of risk. So they will have hedged this year. And in fact, they have told us publicly in many cases that we are complying, however you want to interpret that statement, which tells me they're buying EUAs. So when that 2019 UK auction pot comes to the market, who buys it? And Tom raised that very important point. Who's going to buy it? Are the speculators still interested enough to buy that volume? Will European entities come into the UK market to buy those volumes? We don't know where that demand comes from. Normally, you would know. It would be UK utilities, but they're covered for 2019 and 2020 now. So that's a downside. That's a big downside. There are bigger ones further down the line, but that's the big one for next year.
Tom, we're talking a little about the UK election. I mean, how... what are the ramifications of that? I mean, at the moment, it looks fairly uncertain. It looks like the polls are putting Boris Johnson ahead and the Conservatives ahead. But does that then, amplify the chances of a deal, for example? I mean, could you explain some of the ways that you see how the results of the UK election and the impact that could have on the carbon market?
Yeah, I think you're right. If the Conservatives win, it looks like the deal that's on the table is taken, provided they have a big enough majority to get that through Parliament. I think the risk is probably a hung Parliament again, or someone without a strong enough majority to actually pass a Brexit deal. And therefore we have a general election and end up back in exactly the same situation we've been in for the last 3 years, in effect. So the polls at the moment suggest that the Conservatives will have probably a healthy enough majority to get that Brexit deal passed. But obviously there's still a good month to go until we actually go to the polls, and a lot can change in that time.
Absolutely. I think moving beyond Brexit now and to more other fundamental aspects of the market. I mean, Alessandro, you highlighted the potential of an economic slowdown in Europe. Would you agree here, Tom, that could also have a large effect on the demand for EUAs and carbon?
Yeah, certainly. And I think fuel switching coupled with that is the big bearish factor at the moment. The falling gas prices across Europe are driving fuel switching. There's more fuel switching to come. We've already seen some. And as Alessandro noted earlier, we have this uptake of renewable energy every single year. That capacity grows, and therefore power sector emissions are falling. And that's also being aided by the fuel switch as well now. So there is a significant decrease in power sector emissions expected for 2019 and probably 2020 as well, 2021 even after that. So the MSR is there to counter that, but the issue with the MSR is the time lag. Now that will work both ways. The MSR is effectively looking at emissions totals from the previous year, so it's reacting to what's already happened. Now, that will work the same way when the market tightens, and the MSR may still be withdrawing allowances. But for now, we have this situation where the MSR is almost swimming upstream, I guess. Its effect is being negated by these opposing factors.
Do you have a view on gas prices at all going forward? I mean, I think the key factor here is what happens in the Ukraine-Gazprom negotiations. If they come to a deal by the end of the year, early next year, then that could drive the forward curve, because there's a disconnect between the spot price and the forward curve. If the forward curve then comes down further or crashes down, then you'll see again this fuel switching will continue. Yeah,
sure. And I guess with the Ukraine deal, I think it's in the Ukraine's interest to make sure there is a deal. They rely on the revenues from that gas pretty heavily, and therefore common sense says you get a deal. That doesn't always pan out, obviously. But the outlook for gas prices is bearish for the next year, if not towards 1.5 to 2 years, and therefore there's this continued pressure on carbon prices. There is a limit to the amount of fuel switching that can take place. There's not an unlimited supply of gas capacity that can come online and push coal out the merit order, but that fuel switch is going to work against the MSR. So although the MSR is tightening things, it is going to be a factor that helps keep a lid on prices potentially.
And Alessandro, what's your view here? Then the gas glut, storage is at record high. LNG ships swimming around trying to find a home because there's no, what's your view? How's this playing out for carbon in your view?
Carbon is going to continue reacting to gas in the short term, but we are coming up to a period when the gas market in Europe is going to go through a structural change. You've got Nord Stream 2, which is now progressing faster and has every chance of being online by next year. You then have Russia that's considering and planning to close pipelines that run the southern route. About 2,500 kilometers worth of pipelines that goes through the southern route are going to shut. And effectively, from what I read and study, Russian gas export capacity is going to fall because of the focus on Nord Streams 1 and 2, and then the lack of southern pipelines. So we could end up in a situation where there's less Russian gas coming to Europe. Prices structurally have to move up to compensate for that. And that's going to have an impact on carbon, pushing prices back up. And it risks, in some marginal moments, of bringing coal back at some parts of the year, maybe in the short terms. We have to watch out for that. And it's going to change the dynamic for a lot of places. A lot of parts of southern and central Eastern Europe are not going to have as easy access to gas as they did before. And so all this talk and consideration of, the future is gas, it may be true for the northern part of Europe, but not necessarily for the southern part. And this comes at a time when more and more countries in Europe are coming out with plans to phase out coal. Greece, Hungary, etc. You have to worry about that.
On the other side, you could say that Russia has never pumped as much gas into Europe as has done over the last couple of years, but and Norway the same.
Quite right.
Yeah, absolutely. But I think that's an interesting point. So perhaps this view of a gas supply glut lasting 2-3 years is overdone or overstated.
I'm not saying 2 or 3 years we won't be healthily supplied. I'm just saying watch out for these plans to decommission pipelines in the south.
Okay. So listeners, you have been warned. Tom, if I can, we've had, you've mentioned hedging earlier, hedging by the utilities. We've had a spate of Q3 reports coming out for utilities across Europe. How do you see utility hedging strategies? Are there big differences between them?
There's always differences between hedging strategies. It's very much hedging is a company-specific thing. So obviously plants around Europe have different efficiencies. They have different variable costs. And therefore, it's very difficult to interpret exactly what the utilities are doing at any one time. I think the higher carbon prices are going to be impacting the dirtiest and the most inefficient plants across Europe, and they're probably the ones feeling the pinch with the price rises that we've seen. Now, it's been well documented that RWE have taken a financial hedge against that. Some of them have been proactive in managing that risk. Exactly what they've all done is impossible to know, in all honesty.
Of course,
we can make assumptions based on their reports, but even those reports don't necessarily tell you the full picture.
Exactly, and the full picture will come out when the full year report, because often these contracts, when they go to expiry in December and in the fourth quarter, then becomes much more clearer in February.
Exactly.
February, March. But how about the industrials? You mentioned UK industrials, Tom. How about industrials across Europe?
There's a general shift from reactive to proactive, I would say. It's gradual for sure. What we saw with carbon prices around €5 a tonne is that it was very much something people thought about at the end of the year. Unless you had a very big exposure that warranted kind of real risk management of it, a lot of people are happy to leave that till the end of the year. So they leave that carbon purchasing till the end of the year, safe in the knowledge that price was going to be somewhere between €4 and €6. Obviously, that has seen a huge shift over the last couple of years, and that is driving people to think about their carbon exposure a bit more. It's again, there's no kind of one shoe fits all, but there is certainly a push to actually take a more proactive approach. And people are also realising that phase 4 allocations are falling now. So a lot of industries are still protected by the carbon leakage list and fairly generous free allocations, but nonetheless, over time, people see that the higher prices and the lower free allocation are really combining to drive up compliance costs.
Sure. Alessandro, what's your view here?
And one of the approaches that, say, small and medium-sized industrials take is to try and beat the average price of the year. And given that we are so close, current prices to the average price for the year, this is actually a time for them to look carefully at their balances and say, ooh, maybe we can buy a few if the price dips below 24.91 or whatever it is. Yeah. Certainly, they'll be looking to beat those targets, that average price for the year. That's sort of halfway stage between full risk management on a day-to-day basis and no risk management, which is what we used to see when the prices were 2, 3, 4. This is a halfway stop. And I think more industrials are moving to that kind of semi-proactive.
Well, I mean, you can understand why. The risk is that much greater, of course, and the exposure to those prices is huge. But Tom, I mean, do you think that some companies are not aware of the total cost of carbon? I mean, you have the carbon price, but you also have the knock-on effect, the indirect cost. What's your view here?
Yeah, certainly. And I think total carbon costs will come more and more into focus. A lot of companies until now have looked at their direct carbon costs, and as we said, they were relatively low. They were protected by free allocation and prices were quite low. That is changing. People are generally aware of that and kind of can do the sums to understand some of their exposure at least. Indirect carbon costs are growing with the carbon price. So the carbon price is becoming a bigger and bigger factor in the power price. And what a lot of companies don't understand is those indirect carbon costs that they face. And there's probably a lack of understanding and analysis on how big an influence carbon is in that power price. And now all these guys in the EU ETS are electro-intensive, and therefore it has a huge impact on their overall costs. So whilst they may be receiving a generous free allocation for their direct carbon cost, many are receiving either no compensation or limited compensation for their indirect carbon cost. So it is certainly a changing picture, and I think if you throw into that mix the general movement towards carbon neutrality, there is a growing carbon cost overall. So we have you have the cost of reducing emissions, the cost of potentially voluntarily offsetting the rest of the emissions that you can't reduce, and then there's also things like the opportunity cost of not being green. Consumer trends are changing, investor trends are changing, and therefore companies are really having to understand that total carbon cost now.
So, I mean, could you highlight any companies or sectors in particular that sort of are not so totally aware of their complete exposure?
I couldn't say a sector in specific. I think some companies are certainly more proactive than others. We already see companies that have the carbon neutrality all over their websites, all over their brand, and you're very much aware of who they are. The risk, I think, for those not understanding or embracing this change is that they will very quickly be left behind. And that could have a huge knock-on effect for businesses all across Europe, not just those in the EU ETS, businesses across the whole world, in fact.
Oh, absolutely.
Yeah, there are supply chain companies who don't necessarily have an interface with the public, with the consumers, the ones who serve the retailers, the ones who serve the manufacturers, who are exposed to a cost of carbon, and yet who don't have a compelling corporate social responsibility story to tell, who don't face the public and therefore don't really get impacted by public concerns. Those guys who are stuck in the middle of the chain have no real incentive to look at their carbon costs, except in terms of what their power bills, et cetera, and they maybe get some compensation for that. But these are the people who probably are the slowest to pick up on these trends, the public concerns, and the idea, the benefits of showing yourself to be a properly carbon neutral company.
Yeah. Gentlemen, I mean, a fascinating discussion, but I'm afraid that's all we've got time for today. Tom, thank you very much for joining us. It was a pleasure to have you on board, and I hope we can have you back on the pod to discuss the key carbon issues.
Certainly, and thank you for having me.
And Alessandro, thank you once again. And you're off to the COP very soon, aren't you? In Madrid. Thankfully, not as far as Chile this time, but you'll save on your carbon emissions.
That's correct. I'll be walking the hallways in Madrid.
Perfect. Well, thank you once again, Alessandro.
Thank you.
That's about all from the Montel Weekly podcast this week. Remember to keep up to date with all our stories on Montel News and follow us on Twitter and LinkedIn and subscribe on Apple Podcasts and Spotify. Goodbye.